So we're going to continue our series of options trading myths today, and today we'll be discussing options myth number 8, and that is a statement you'll hear from a lot of traders who are just getting started, and they will say, the trade I normally enter today, let's say they start trades 8 weeks out from expiration, the trade I would normally start today, I'm not going to start because the prices are too expensive. In most walks of life, that would be a true statement. You don't want to buy when things are too expensive, but options, positive theta, market neutral trading is a little bit different, and that's because time is your enemy. So let's take a little historical look at things to understand why it's not that smart to say, I'm not going to buy my position today because prices are too expensive. We're in the middle of an 8-year historic bull market. It started in March of 2009. It's continued with very little interruption through to today, September of 2017. And options volatility has actually gotten very low as I've ever seen it as an options trader myself. The VIX has been hanging around the 10 to 12 level pretty much all year, 2017, with some very minor exceptions. And the RVX, which is the sort of the VIX of the Russell 2000 index, has recently actually gone to historically low levels. And so we are in really consistently low volatility times right now. And here's the thing about options volatility dropping out like it has. It can drop out and stay dropped out for extended periods of time. I'll give you an example. The VIX closed below 14 almost every day from mid-November of 2016 through March of 2017. The RVX had a similar pattern below 20. So it's not like options volatility drops to a low level and runs away from that level. It can often stay at those levels for extended periods of time. And so let's try to take that fact and combine it with the statement, I'm just going to wait until prices get better. We are positive theta options traders. Here on our trading desk, in the options tribe, many of you listening to this video are a positive theta options trader. Well, think about those kinds of trades. They are built to get more expensive as every day goes by if all other things are equal. Why? Because of the time decay of options. So let's take a look at this example here. You can see a butterfly, hypothetical butterfly that was set up, and that butterfly hypothetically would have cost $4,455 this morning, all right? In 15 days at the same price point, that same butterfly will cost $5,320. In 29 days, it'll cost $6,600. In 44 days, it will cost $8,700. And at expiration, 58 days later, the November expiration, this will cost almost $10,000 more, $14,453 at that same price point. All right? So I hope that that little discussion has proven to you that if all you need is the passage of time, if you get that passage of time and all the other factors remain the same, the trade's not going to get any cheaper, it's going to get more expensive. And so most successful options traders keep their capital in the market pretty much all the time. Why? Because they realize that waiting around for a better price is actually a little illogical. Can you get a better price by waiting? Of course it's possible. But the odds are against you because time, which always marches on, is against you. Time is always going to be against you in positive theta positions. Worse, people with that thought process find many times that they are not going to get a better price They'll wait around for a day or two or three. They finally get impatient as the price continues to get higher, as time continues to march on. So then they jump in at an even worse price than they would have, making it less likely they can make a decent profit on the trade and more likely that they will get stopped out. So what's the moral of this story? The moral of this story is time is working against you in positive theta options trading. To wait for the price to get better is taking one of the factors that makes these trades work and using it against yourself. So that doesn't sound like a very smart thing to do. Generally speaking, you're better off keeping your capital in the market, accepting the current pricing, and moving on from there with an assumption that time is going to work for you. Statistically, from a probability, from a theory standpoint, you're going to be better off long term, not waiting around for better prices. So I hope that you take that into consideration. Next time you have that thought you're going to wait for better prices, think about the fact that everything about those positions is conspiring against you, and probably better to just jump in the market that day. Thanks very much, and we'll see you next week.